All right, after nearly a year of cuts, the Bank of Canada has finally hit pause. But don't mistake that for we're done. We've still got a long way to go. And if you're renewing, buying, or sitting in a variable right now, the next 12 to 24 months are going to shape your strategy in a big way. I'm Justin Chaussee, mortgage broker, helping Canadians from coast to coast make sense of real estate and financing. If you want the real world version of what this all means, not just headlines, hit the subscribe button so you don't miss out on the next couple updates. So let's break this down. We've had 6 straight rate cuts from the Bank of Canada since June of 2024, dropping prime from 6.95% all the way to 4.95% as of March in 2025. That's a huge shift and the kind of drop that starts unpacking opportunities for buyers and relief for borrowers. But in April of 2025, the bank held rates steady. No cuts, no hikes, just a pause. So what does that mean? The bank is saying, let's wait and see. Inflation is cooling. March came in at 2.3%, well within their comfort zone. But core inflation, the stuff that excludes gas and food, are still a little sticky, and that's keeping them cautious. They don't want to overcorrect, drive up demand too fast, and end up chasing inflation again 6 months from now. So this pause is not the finish line. It's just a chance to breathe. Now here's where things get really interesting. The forecasts. Markets are pricing in another 0.5% in cuts by the end of the year, which could bring the Bank of Canada rate down to 2.25% and prime all the way down to 4.45% by December of 2025. And then, well, it's going to be flat for a while. According to the latest projections, the Bank of Canada is expecting to hold its rates steady through 2026, 2027, and 2028, all with minor upward movements in 2029, back to 2.75% for the Bank of Canada and 4.95% for prime. So the translation of this is we're heading into a window of rate stability. No fireworks, no panic, just breathing room. So what did this mean if you're making mortgage decisions right now? So let's break it down. If you're renewing this year or next, you're in a great spot. You've likely been riding rates in the 5.5 to 6.5 range if you've gotten a mortgage within the last 24 months. With prime at 4.5% and fixed rates trending lower, your next term is going to feel a whole lot better for you. A 3-year fixed is still the sweet spot right now. It gives you savings today, but puts you back in the market in 2028 when things may look very different. But if you're conservative or just want to lock in and forget it, a 5-year fixed under 5% is still a strong move too, especially with forecasts showing the flat rates into 2028. If you're buying this year, the combo of lower rates, softer home prices in some regions means this might be the best stretch we've had in a few years. Don't try to time the exact bottom. Nobody can nail it. The smarter move is to get fully pre-approved with real numbers and not just an app that spits out a ballpark. That way you're ready to move when the right property hits. If you've been on a variable rate, you're finally catching a break. Every cut over the past 10 months has chipping away at your monthly payment. But here's the big question. Do you ride it out or do you lock in? The answers come down to 2 things. How comfortable are you with some movement? Whether you'd rather have a firm number or the flexibility to pivot. Because if you're comfortable riding this trend, the data suggests variable rates are back in play, especially with prime projected to settle in around 4.45% in the next 6 to 9 months. Now let's talk risk, because it's not all smooth sailing. Even with inflation coming down, the Bank of Canada is watching 3 things closely. Wage growth. If salaries climb too fast, it can only reignite inflation. Spending habits. People are still sitting on savings from the pandemic, and higher confidence could trigger more spending. And global pressure, especially with Trump back in the US imposing new tariffs on Canadian export. And add to that our own political instability with another minority government post-election, and you've got a recipe of caution, not celebration. So if you're planning a refinance, a renewal, or a purchase, this isn't the time to roll the dice. It's time to build a plan. Here's what I'm telling clients right now. Don't overextend. Just because you qualify for it doesn't mean you should have it. Give yourself margin. Rates might drift down a bit more, but don't bank on it. Focus on stability, whether it's term length, penalties, or prepayment option. And if you're not sure, ask. It's literally what I'm here for. The path ahead looks more stable than it has in years, but stability only helps if you use it strategically. So if you're wondering how to play this next stretch, let's talk. Whether it's restructuring your renewal or making sure pre-approval is locked and accurate, this is the time to get it right. And if you want more updates like this, plain language, no fluff, hit the subscribe button so you don't miss what's coming next. We'll talk soon.